What if I told you that the streaming giant everyone thought would never turn a profit just delivered numbers so explosive that Wall Street had to completely rewrite their models? I'm Smart Stock Sam, and today we're diving deep into Spotify's latest earnings to answer the burning question: is this stock about to explode, or are these massive earnings hiding something darker? Stick around, because what I'm about to reveal will change how you see this company forever. Spotify just reached an inflection point that has silenced years of skepticism. We're looking at a staggering 241% surge in net income. For years, the narrative was growth at any cost, burning cash to capture market share. But as of Q4 2025, something fundamental has shifted. Spotify has officially transformed into a structurally profitable ecosystem. The question is, how did they pull this off, and can they sustain it? Let's talk numbers, because these are frankly jaw-dropping. Earnings per share came in at $4.78, and they've achieved a record-breaking operating margin of 15.5%. They're now serving 751 million monthly active users globally, and management is so confident in their future trajectory that they've already executed $510 million in share buybacks. On the surface, this looks like total vindication of their long-term strategy. But here's where it gets interesting. There's one hidden metric buried deep in these results that completely changes how you should interpret this profit beat. Could this be a one-time accounting windfall rather than sustainable business performance? We need to dig deeper. When we compare Spotify's performance against Wall Street expectations, the results become even more impressive. Analysts expected an EPS of around $2.96. Spotify crushed it by nearly 70%, landing at $4.78. Revenue held steady at $4.89 billion. But the real story is that 13% beat on operating income. They're squeezing significantly more profit out of every dollar than anyone predicted. But was this beat driven by genuine operational excellence, or is there something else going on? Here's what most investors will miss completely. A significant chunk of that operating income, $72.36 million, didn't come from selling subscriptions. It came from lower than expected social charges in Sweden. Because Swedish payroll taxes are tied to stock price movements, Spotify got a massive accounting windfall. This is volatile. A 10% stock move can swing costs by over $32 million. So while the headlines look phenomenal, what happens when this reverses next quarter? Spotify's user growth engine is absolutely firing on all cylinders. They just delivered their largest quarterly user addition in company history, bringing in 38 million new users in just 3 months. This pushed them to a massive 751 million monthly active users worldwide. A huge driver of this explosive growth was the annual Wrapped campaign, which saw 300 million users actively engaging with their personalized year-end statistics. This proves something incredibly powerful. Spotify's social flywheel has become their strongest organic marketing tool. When users share their music taste publicly, it creates a viral loop that costs Spotify virtually nothing. But the critical question remains: can they maintain this momentum, or have they already captured everyone who's ever going to use the platform? Users are one thing, but monetizing them effectively is an entirely different challenge. On the premium subscriber side, Spotify added 9 million new paying customers, comfortably beating their own internal guidance. What's particularly impressive here is the low price sensitivity they're witnessing. People are maintaining their subscriptions even as Spotify has raised prices significantly across the US and Europe. This suggests real pricing power, which is frankly rare in consumer subscription businesses. However, the ad-supported side tells a completely different story. Ad revenue actually declined by 4% this quarter. Global pricing pressure in digital advertising is very real, and this is a segment we absolutely need to watch closely moving forward. If premium growth slows while ad revenue stays weak, where does the growth come from? So if their ad business is struggling, how is Spotify still hitting these impressive 33% gross margins? The answer lies in their aggressive move beyond music. By expanding into audiobooks and launching their partner program, they're fundamentally diversifying their content cost structure. Their new marketplace strategy, where record labels actually pay Spotify for sponsored recommendations and playlist placement, is generating high-margin revenue that simply didn't exist a few years ago. This is the core investment thesis for why the stock is being re-rated by the market. They're transitioning from a low-margin music streamer to a diversified audio platform with multiple revenue streams at vastly different margin profiles. Beyond revenue diversification, Spotify is building a formidable technological moat around their user base. Their AI-powered discovery tools, like the innovative prompted playlist feature, turn your music library into a deeply personalized asset that becomes incredibly difficult to leave. The switching costs aren't financial, they're emotional and habitual. Additionally, with their beta video feature now rolling out across 112 markets, Spotify is directly competing for the time you used to spend on YouTube or TikTok. And for industry critics who claim Spotify doesn't pay artists fairly, they paid a record $11.88 billion to the music industry this year alone. But here's the trillion-dollar question. Can they maintain these expanding margins while continuing to pay the industry more every single year? Now, all of these positives don't matter if we ignore the significant risks lurking in the background. The biggest threat to Spotify right now isn't Apple Music or YouTube Music, it's currency volatility. Foreign exchange headwinds created a massive 580 basis point drag on revenue this quarter. Even more concerning, management has explicitly guided that this will worsen to 670 basis points in Q1 2026. When you're operating in every corner of the globe like Spotify does, the strength of the US dollar can absolutely shred your top-line growth numbers overnight. What happens if the dollar strengthens another 10% from here? With all these moving parts, investors are asking the critical question: what is Spotify actually worth at current levels? Right now, the stock trades at a price-to-sales multiple of 4.37 times. Compare that to Netflix, which trades at 7.7 times sales. Why the massive discount? It all comes down to margins. Netflix operates at roughly 20% operating margins, while Spotify is just hitting 8%. But here's what the market is betting on. As Spotify approaches those mid-teens operating margins over the next few years, that valuation gap should compress significantly. Technically, investors are watching the $492 level as key resistance. A decisive break above that could trigger a major move higher. Looking ahead to the immediate future, management has provided guidance for Q1 2026. They're expecting $4.86 billion in revenue and operating income of $712.8 million. The focus from their new co-CEO structure is crystal clear: value over volume. They're specifically targeting 5 to 6% growth in revenue per user, signaling that the era of chasing free users at any cost is definitively over. We're now entering the era of extraction and efficiency. The company is optimizing for profit, not just growth. The ultimate validation of any business model comes down to cash generation, and this is where Spotify's transformation becomes undeniable. They finished 2025 with $3.13 billion in annual free cash flow and a fortress balance sheet holding $10.26 billion in cash. These aren't the numbers of a struggling startup bleeding money to gain market share. These are the metrics of a maturing cash-generative business. Before we wrap up, I need to provide an important reminder. Nothing in this video should be considered financial advice. I am not a licensed financial advisor, and this content is for educational and entertainment purposes only. Always conduct your own research and consult with a qualified financial professional before making any investment decisions. Investing in stocks carries risk, including the potential loss of principal. So what's the final verdict on Spotify? This is no longer a speculative tech play trading on hope and future promises. Spotify has fundamentally transformed into a maturing cash generator with improving unit economics and expanding margins. Despite the noise from currency fluctuations and volatile accounting items like Swedish social charges, the core business is demonstrably stronger than it has ever been. Spotify has finally found its rhythm, and the market is starting to recognize it. This is Smart Stock Sam, reminding you to stay curious, stay informed, and I'll see you in the next one.